We're just going to give it a couple of minutes before starting, just to allow people the time to join. For those that have joined, we're just giving it a couple more minutes until we start, just to allow people time to hop on. Okay, we'll get started. So hello everyone, and thank you for joining us today. Welcome to our new tax year new rules webinar. We'll be covering some of the biggest questions that we're being asked right now by limited company directors and business owners. There's been a lot changing with the increase in dividend tax and making tax digital to the best remuneration strategies and key allowances you should be using. Understandably, it can be difficult to know what actually applies to you and what action you should be taking. So today is about clarity. We're going to break down the practical implications behind these topics, explain what you should be thinking about, and give you clear guidance you can use to make informed decisions for your business, help you start the new tax year with confidence. We've structured this session around the real questions our clients are asking us. Before we start, we'd love to get a quick sense of the room. On the screen now, you'll see a QR code. If you can scan it, it'll take you to a short word cloud where we're asking one simple question. When you hear making tax digital, what comes to mind? It only has to be one word: confusion, compliance, software, whatever your honest reaction is. We'll leave it open for about a minute and then we'll share the results shortly. We can have up to 50 participants. If you're unable to input a word, pop it in this chat and we'll manually add it in and post it on our social media. It'll be really interesting just to see how everyone's feeling about MTD before we break it down properly. Let's give it a little minute. Okay, so to start off with, Saudi will be covering the up and coming changes to rental income taxation and what to consider if you're planning to rent out a property, the benefits of pension contributions, and whether buying a car through your company is actually worthwhile. Then we'll hand over to Tommy, who will take us through making tax digital, what MTD is, who it affects, and whether you need an accountant to manage the new requirements. And then Stuart will round things off by looking at what in the budget may affect limited company shareholders and directors, whether the recommended way to take money out of the company has changed, and what you can do with surplus profit if you're not planning to extract them as remuneration. And then we'll leave time at the end for questions, so please do submit those throughout. We want this to be as useful and as practical as possible. So let's get started. Saudi, the first one's for you. With the upcoming changes to rental income taxation, what should my considerations be if I'm wanting to rent out a property?
So I thought it might be useful to just round off on what is changing with rental income, just so everyone's aware of it and everyone's on the same page. So from April 2027, the government have announced that there's going to be an increase in the tax charged on rental income by 2%, and that's 2% across everyone. So if you're a basic rate taxpayer, you're going to be paying 22% rather than 20. If you're a higher rate, you're going to be paying 42% instead of 40, and additional rate, you're going to be paying 47% instead of 45. The other thing that has changed are the compliance needs. So MTD is the big word that's been going around recently, and that is now coming into play. If you have rental income and sole trade income where your combination of that is over £50,000, from April 26, you are having to register for being MTD compliant. And then from April 27, that threshold is actually reducing down to £30,000 as well. So what should you think about? The main question I always get asked is it worthwhile putting this rental income via a limited company? And there's no hard or fast rule. The situation sort of depends on what route you should be taking. Now, I'll just talk about some of the benefits of having the income via a limited company, and some of the downfalls of it as well. So if you're in a limited company, you don't have to worry about doing MTD filings at all. You just have to worry about the compliance of being a limited company. So filing a set of accounts, filing a corporation tax return, confirmation statement filings, and so on. You would be paying corporation tax on your rental income profits. Usually we find that it's at a rate of 19%, but obviously if your taxable profits are over £50,000, you might be in an effective rate of paying 26.5% for some portion of it. And if your profits do go over £250,000, then you're paying 25% as well. What you also need to worry about is if you are a limited company, limited companies are not exempt from paying stamp duty at all. So if, for example, you have a rental property now and you're thinking about putting it into a limited company, the limited company is going to have to pay stamp duty on the purchase of that property from yourself. Now, with stamp duty, you can sort of get around it a little bit. If you have moved out of your, so let's say the main property that you are renting out used to be your primary residence. If you moved out of it within 3 years and then sell it, the additional stamp duty that you paid on the purchase of your second property, you will be able to get that refunded back to yourselves. And we have helped clients with that in the past too. Now, what you should also bear in mind is whilst corporation tax rates are lower than the income tax rates, you are still having to take the money out of that company. Now, if you don't have a director's loan account there, the only real main form of taking that out is going to be a dividend. So you are essentially being double taxed there. The other side of being double taxed is when you come to sell that property. If you sell that property, any gain that you make is going to be liable to corporation tax first. And let's say you only have the one property in the company and you're going to be shutting that company down once you're done with it. And once you've sold that property, you're going to be paying capital gains on the closure of that company if there are funds to be withdrawn. So do bear that in mind. Some things to sort of think about on it would be how long are you intending to keep that property for? Is it going to be a long-term investment side? If so, makes more sense to go down the limited company route. If you're a basic rate taxpayer or you're not paying any income tax, then I'd probably say go down the route of having it in your personal name and go with that. Or if you're not looking at extracting any money from the rental income, you've just got it sat there just to generate a turnover, generate profit, then it does make more sense to go down the limited company route. The last consideration I'd sort of put out there as well is inheritance tax. It's a lot easier to transfer shares via inheritance than it is to actually transfer a property over. There's more reliefs involved, so just bear that in mind too.
Super, thanks, Saudi. And I'm thinking about buying a car through the company. Is that worthwhile?
So for a car, there are a lot of considerations to make. So some of the benefits of having a car in the company, all the running costs of that car can be put through the company. So if you're filling up, if you are putting new wipers on the car, new MOT needs doing, new tyres, new wipers, whatever it might be, those expenses can go through the company, and obviously therefore it becomes an allowable expense and saves you corporation tax. Now, what you do have to worry about sometimes is the VAT element. So one of the main questions I always get asked is, should I buy it or should I lease it? If there's a private use of that car in any way, shape or form, buying it outright might not be worthwhile doing because of the VAT. You would not be able to reclaim any portion of that VAT at all. Whereas if you were leasing it, if there's a private use, you'd only be able to claim back 50% of the VAT. So there is still form of VAT being reclaimed back there now. Going from that, the main thing to take into account with a car is the benefit in kind and how that is sort of calculated. Some people do get confused by this. So just to sort of explain it, the value of the benefit in kind is the list price of that vehicle multiplied by a percentage based on the CO2 emissions of that car. Now, the list price of that car is not what you've actually purchased a car for, it's what the car was worth brand new out of the showroom. So I've had a client in the past where they bought a used BMW 3 Series that they bought for £5,000. It was a diesel car. So CO2 emissions based on the car can be anywhere between 2% to 37% if it's a diesel car. So it was a diesel and it had really high CO2 emissions, so it was at the 37%. The benefit in kind was actually more than the car was worth in itself, so it probably wasn't worthwhile doing. You do get reduced rates for if it's a hybrid, so if you've got a certain electric mileage range. And again, if it's an electric car outright, your benefit in kind percentage rate is going to be at a rate of 4% from next year. So sometimes it is worthwhile doing. Now, with the implications of what you have to pay as a benefit in kind, the company itself will pay Class 1A national insurance. So that went up from 13.8% to 15.05%. So do bear that in mind. And then the value of the benefit of the car would also be added onto your personal tax return as income tax. So you'll be paying it as if it might as well have been salary that you had taken there. So be it 20%, be it at a 40% rate, depending on where you fall in your tax ratings. Otherwise, if it's electric, my sort of rule of thumb is unless it's electric, potentially it's not worthwhile doing. If it is electric, then yes, we can look at doing it.
Thanks, Saudi. And lastly for you, what are the benefits of pension contributions and should I do it through my company?
Pension contributions at the minute are the biggest way we look at saving people's corporation tax rates, especially when they're falling into paying the marginal rate of corporation tax at the 26.5%. So there's two ways that you can sort of benefit from pension contributions. It's if you pay for it privately or if you pay for it via limited company, and they both have different sort of impacts on you. If you pay for it via yourself personally, what you would be doing there is increasing your basic rate band of tax. So you'd be paying more tax at 20% rather than 40%. If you are paying for it via your company as part of, for example, a director's remuneration package, it would be a company allowable expense, so you would be saving corporation tax. So it's sort of defining which one is going to be more beneficial for yourself. So a few things to sort of consider there. If you have income that is just your salary and your dividends from the company, more than likely it's going to be more beneficial to pay for the pension via the company, because that way you're saving the most amount of tax there. You're not paying much tax at 20%. Whereas if your limited company is more of a side business, you're using it as an investment side of things, something to fall into as you're growing it, but you have a lot more personal income. So you have a few jobs there, you've got income coming in that is taking you over into the high rate band, then it is worthwhile doing it via the personal side. One thing I do always sort of say to my clients as well is it worthwhile doing? So whilst I'm saying it's saving you corporation tax, it's saving you income tax, it's more of a delay tactic. You will have to pay tax on that income eventually, and that would be when you start withdrawing money from your pension scheme. Now, as it stands, you'd be paying income tax on that of that pension income as you receive it. Now, who's to say what rules won't change up until the time you do start taking money out of that pension scheme? So do bear that in mind. The other side of it is from a cash flow point of view. Do you actually have the cash to make the contribution? Is it worthwhile to save the 2.5 grand of corporation tax that you would save if you put £10,000 into a pension scheme, for example? Sometimes it's not worthwhile. So do look at that cash flow as well. It's very important.
Great, thanks, Saudi. If anybody's got any questions on what Saudi's discussed, just pop it in the chat and we'll get through as many as we can at the end. So Tommy, next one's for you. What is MTD?
So Making Tax Digital, or MTD as Lara's just called it, is HMRC's plan to modernise the UK tax system, so moving it towards digital record keeping and digital reporting. So historically, many people manage their finances in their own way during the year, often using a spreadsheet or paper records, and then everything is pulled together once a year when the tax return is prepared. The problem HMRC identified is that when these records are only reviewed at the end of the year, mistakes are more likely to happen, things can get missed, Figures may be estimated rather than accurate, and it can be difficult to get a clear picture of how a business is truly performing. MTD is designed to improve that by encouraging people to keep digital records throughout the year and connect those records directly to HMRC through a list of approved software. Instead of preparing everything in one go, information will be recorded and reported more regularly, which should reduce errors and provide a more accurate view of someone's tax position. For most, simply means using accounting software to record income expenses as they happen. The software then allows the information to be submitted directly to HMRC. So while the name Making Tax Digital sounds like a big change, in reality it's mainly about keeping financial records digitally and keeping them up to date during the year, rather than leaving everything until the last minute.
Perfect. And can you tell us who does MTD affect?
So at the moment, MTD has already been introduced for VAT. So all VAT registered businesses are already required to keep digital records and submit their VAT returns using compatible software. The next stage, which is the one that everyone's talking about currently, is Making Tax Digital for income tax, which is set up to affect those who are self-employed or landlords, and that's individually. So from the 6th of April 2026, the rules will apply to individuals who earn more than 50k from self-employment or rental income. And then from the 6th of April 2027, it's expanded to include those earning more than 30k from those same sources. Now, under this system, those individuals are going to be required to keep digital records of their income and expenses and send quarterly updates to HMRC during the year through a software of their choosing, again, ensuring it's on the list of compatible software. There will still be a final submission at the end of the tax year to confirm those final figures, but the idea is that HMRC and also the individual will already have a clearer picture of the business activity throughout the year. Limited companies are not included in this stage of the rollout, so you'll continue submitting annual corporation tax returns as you are already doing. However, there has been some indication from HMRC that a similar digital reporting system could be coming in the future.
Perfect. And can you tell us, do I need an accountant to deal with the MTD requirements?
Now, shockingly, I'm going to say, in theory, no. So you don't legally need an accountant in order to comply with Making Tax Digital. You know, if you're someone who's comfortable with the use of accounting software, you know how to keep those accurate records of your income, of your expenses, then by all means you can manage those requirements yourself, and there's no requirement for an accountant as such. What most people are finding, however, is having an accountant involved helps ensure everything is being done both correctly and efficiently. So tax rules are still complex, they always have been, and it's important that the figures being reported to HMRC are accurate and that all allowable expenses, for example, are being claimed properly. Now, an accountant can also help you understand what the numbers mean. So rather than you just submitting figures to HMRC, we're going to look at the numbers, how you can use those to understand profitability, manage the cash flow, and also plan for upcoming tax liabilities as well. For many business owners, landlords, self-employed, that ongoing support is where the real value from an accountant will come from. Biggest thing I would say about it all isn't to panic about it. If you feel like this is going to be something that applies to you, the right setup, a bit of planning, most of you will just find it's a different way of doing something that you are already doing. It may just take that time to speak to someone and ensure that you are really on top of it. It's essentially what you're already doing, just in a more digital and organised way.
Thanks, Tommy. Okay, Stuart, is there anything in the budget that is going to affect taxation for a limited company shareholder or director?
Okay, thanks, Lara. So the only direct change to taxation is in the form of increased dividend tax rates. For both the basic rate and the higher rate, there's an increase of 2 percentage points. So in the basic tax bracket, the rate is going into double figures for the first time at 10.75%. And in the higher rate tax bracket, it's up to 35.75%. So that's obviously taxation increases for anyone who takes dividends out. Obviously, the more dividends you take out, the more of a hit you're going to feel from the increased taxation rate. So, for example, someone who takes dividends to fully utilise their basic rate tax band, which is around £37,500 in dividends, is going to be facing about £750 extra tax each year. This is up to about £150 extra for someone taking £60,000 in dividends, and for someone lucky enough to be able to take £100,000 plus in dividends, the extra tax is going to get towards £2,500. A very slight plus point, although nowhere near negating that, is that for anyone with a student loan, the thresholds for repaying the student loans are increasing slightly, depending on the plan type. It might work out at about £100 a year for most people saving compared to comparable income in the last tax year. So those are the only two direct effects, really. Indirectly, there are some effects because the Chancellor has committed to freezing the personal allowance and the tax bands until 2031. So for all taxpayers who are seeing an increase in income, whether that's because they want to take more money out of the company or because their salary is increasing with inflation, they're potentially going to be crossing tax bands that they haven't seen previously. So at the bottom end, someone who's very low paid, probably working part-time, and pensioners, and that's quite a common one in the media, are going to be dragged into taxation for the first time because their income now exceeds the personal allowance because it's increasing with inflation. And at the other end, people, limited company owners who take dividends, who previously only paid tax in the basic rate, could find their income being pushed into the higher rate if they need to take out more to deal with the cost of living increases. So indirectly, there's an effect as well.
Perfect. So has anything changed on the advised way to take money out of a company?
Well, fundamentally, no, not really, because as I mentioned, the tax bands are freezing. So it's pretty much business as usual. That means for most people, the standard personal allowance salary of 12,570, and the remainder in dividends is still going to be the optimum strategy. So a couple of clients have questioned whether paying more salary might be better to offset the higher dividend taxes because rates on salary aren't going up. Might be tempted to think that, but the dividend tax rates would have needed to increase by a lot more before paying salary became the better option for most people. There are always a few exceptions for anyone with other income from outside the company from other sources, or where they have genuine employees on the payroll and are claiming the employment allowance. It could be worth looking at another strategy. We're always happy to answer those questions.
Thanks, Stuart. And then one last one for you. What can be done with any surplus profit in the company if you're not taking it out to pay remuneration?
So number one is probably pensions, as Saudi's discussed. A lot more clients are seeing pensions as part of a remuneration package now. But as Saudi mentioned, obviously deferring that income to 10, 20, 30 years in the future, maybe less, when we can't be sure what the tax regime is even going to be at that point, and that money will be taxable when it's taken out. There's a few quick wins for using the surplus in the company. So it's always worth looking at opening a company savings account and seeing if you can get a higher rate of interest there. If there is surplus money in there, even if that's just £15,000 that's sitting waiting to go out for corporation tax, if you can invest that for 6 months in a savings account and get 2 or 3% interest, then that's still better than it's sitting in the current account not earning anything. The company can invest the money really however it wishes, and we do have clients who invest in shares and cryptocurrency, etc., even property, as Saudi's talked about. Anything that the company's investing in would have to be the company investing in its own name. So as soon as you take the money out of the company and say, well, I'll invest this, well, straight away that becomes your income that has to be accounted for. So the money would have to stay under the company's ownership. With things like investing in shares, property, etc., any profits or gains are going to be taxable in the company, along with the corporation tax. So sometimes making these kind of investments, not taking the money out in cash, is a long-term strategy, and some people will do this because once they retire and stop actually trading with the company, they can then start drawing down on money that's been built upon in the company from investments in a similar way to as if they're drawing down from a pension.
Perfect. Thanks, Stuart. So we've got a couple of questions now that we will ask. If anybody else got any questions, please just pop them in. So the first one is, and it's probably for Stuart or Sally to answer, is there a limit to how much my company can contribute into my pension? And are there any tax advantages compared to paying myself and contributing personally?
I'll go for this one, if that's all right, Stu.
Yeah,
So
that's fine.
the pension limit is not down to the company, it's down to the actual individual. So each individual has a limit of around £60,000 a year at the moment. It used to be £40,000, but it has increased. That threshold can be reduced depending on your level of income. If you've got income over £200,000 and relevant threshold income of £260,000, which I won't get into now, that threshold of £60,000 can be reduced, but that is a very rare situation to be in. The rule of thumb is the maximum amount personally across any sort of contribution you're making is £60,000. So if you're doing £30,000 personally and £30,000 via the company, that is your £60,000 met.
Perfect, thank you. One for Tommy. If I'm already using accounting software, does that mean I'm automatically compliant with Making Tax Digital, or are there additional steps I need to take?
It's a good question, really. And to be honest with you, the answer really is not necessarily. So using accounting software is a good start, but it doesn't automatically make you compliant with Making Tax Digital. So if you're going to be fully compliant, you need to first ensure it's on the list of MTD compatible software. So making sure you're keeping those digital records, and then making sure you're actually submitting that tax information to HMRC directly through that software. So to do so, you're going to either need to have an accountant or have your own HMRC account that's signed up to the relevant Making Tax Digital service. So if that's for income tax, making sure you've signed up for that. Now, in short, the software is the tool that's going to enable you to do those submissions, but you still need to ensure you're with the correct software, you're keeping those records, and that you signed up with HMRC.
Super, thank you. Next one, with the dividends tax changes over the past couple of years, is it still worth reviewing our remuneration strategy annually, or do most directors tend to keep the same structure year to year?
Yeah, good question. So what we always do here is when the new tax rates are announced, and nothing much has changed in the past few years. Obviously, I've just talked about dividend tax increases, but we're always looking at the optimum strategy for you and advising that across the board, really. So you can be sure that we're always working out which way is going to be best for you. And if needs be, we will change some of our advice. Now, this did happen a few years ago when the personal allowance was increased to 12,570, which was quite an increase at the time, and that was above the threshold for paying national insurance. And we looked at this and decided to revise a salary at the personal allowance level, even though that would incur employers' national insurance, which isn't something we'd done in the past, but we saw the way the rates were changing and did work out the figures and the benefit for you of taking a salary at the personal allowance level rather than the lower threshold for the national insurance as we'd done in the past.
Thanks, Stu. Next question, can I go back to previous years and take pension contributions?
Oh, am I muted? I don't think I am. Yes, so you have a 3-year leeway. So if you're not fully utilise your threshold from the past 3 years, we can look at utilising that into a contribution, which can take you over the £60,000 threshold in 1 year. But we'd have to do the maths on it. So yeah, get in touch with us about that and we can help you with that.
Okay. If I earn, Tommy, this one's probably for you. If I earn more than 50k in financial year 25-26 through salary and rental income, I'm selling my rental property on the 6th of April 2026 and no longer expect to be earning more than 50k personal plus rental in 26-27. Do I still need to set up MTD for the 26-27 tax year?
If you're looking to sell the rental and you haven't already met the requirements, then the main thing to do is ensure that you make HMRC aware of that. So as long as they're made aware, then you're not going to meet those requirements anymore, then there'll be no requirement for you to keep track of those records. But it's important you tell them what HMRC are doing is they're using figures previously submitted. So if you were to purely submit that and make no notice to them of that no longer being the case, they'll automatically assume that you should be falling part of that system and start sending you letters, emails, trying to get you on it. So by all means, you wouldn't need to, but make sure that they're aware, or something an accountant can help you do as well.
Okay, and while you're on MTD, Tommy, someone's asked, can free agent be used to complete the MTD inputs?
Yeah, so free agent is on the list of compatible software. It tends to be that they're adding more and more every week at the moment, but at the moment the main ones are looking like free agent, Xero, and QuickBooks.
Perfect. Stuart, this is probably one for you. It's quite a complex area, so can you give a brief overview? Could you outline the rules and the benefits of AB shares, re-dividend payments? They have 3 adult kids with different levels of personal income. Just a brief overview, and then we can answer in full in detail.
Yeah, I could talk all afternoon on this, really. In theory, yes, it is possible. You can have other people owning shares in your company. Now, one of the first things to bear in mind is that you can't be benefiting from the income yourself. So if it was the case, and I'm not sure that anyone would ever admit this to HMRC, but if it was the case that you made someone a shareholder in your company, you paid them dividends, they paid a lower rate of tax than you did, and then the money came back to you, well, that's clearly an avoidance measure. There's specific legislation that says if you retain an interest in the income, then it will be taxed on you personally. With adult children, that's probably not going to be the case, really. I'm sure you're probably looking at giving them dividends now as a way of contributing to them, really. Once they're over the over the age of 18, then it is fair enough. In terms of making that transfer and setting that up, you've got to be aware that you're effectively making a disposal of your shares for capital gains tax purposes. So if you've got 100 shares and you give 20 to one child and 20 to the other, you're effectively disposing of 40 shares, and that has a capital gains tax implication. The company would have to be valued, and it's deemed that you're taking the proceeds, even though no money is changing hands for tax. It is possible in some cases to defer that capital gain, to put it on to the recipient of the shares, whoever you're transferring the shares to. So in summary, yes, possible. Difficult to set up, not as easy as people think, really, but we can certainly look at individual cases.
Perfect, thank you. And then just one last one, Saudi, someone's asked about the company car. What are the implications of business contract hire?
So it goes on. Yeah, I started answering John's question in the chat a little bit there. So I know he asked about the difference between a lease and a PCP. It is very rare to get a PCP in a company name. Most companies won't allow it, purely because PCP in its own right is a personal thing. So do bear that in mind. You do often find that they can do it sometimes, and if that's the case, it's just going to be treated like a lease there. In terms of the what the benefits are, just to quickly go over. If your company owns the car, any running costs of that car can go through the company. The main implication is going to be for the VAT element. If your company outright has bought a car and there's going to be private use, you will not be able to reclaim any sort of VAT on that car purchase. If you are leasing the car and there's going to be private use on that car, then 50% of that VAT can be reclaimed still. Just bear that in mind.
Okay, and then one last one. If your rental income is below 30,000 per year and the rental property is personally owned, not through your company, do you just enter the rental income in your self-assessment at the end of the tax year and not required to register for MTD as the rental income is below £30,000?
That's correct, yeah. So if your rental income is going to be under the £30,000, then you can just carry on doing it on your personal tax return as normal.
Perfect. Okay, so I think that's everything. That brings us to the end of today's session. Hopefully what we've covered has helped make some of the up and coming changes clearer and give you a better idea of the things you should be thinking about as you move into the new tax year. Thanks for taking the time to join us today, and thank you to Saudi, Tommy and Stuart for sharing their insights. We'll also be sending out a follow-up email with the recording of the webinar along with the answers to any questions we didn't get to during the session. Thanks everyone.